right, traders, welcome back to part 3 of this series on price waves and mom waves. And just show you a couple other variations here that are kind of cool. So this one is combining mom waves with the, guess what? The famous rubber band trade. So here we go. We've got a wave 1 on price, but it never goes any further than that. And part of the reason for that, by the way, is because this is a parabolic move. Now, this is a 1,000 tick chart. 1,000 tick chart, any tick chart, any type of chart that isn't a time-based chart, you don't see the parabolic moves as dramatically. So parabolic move generally is a steeper than 45-degree angle, but when you've got tick charts, then they create more bars. And if you have a time-based chart, then they don't create as many bars, so therefore you get a steeper angle. So the parabolic moves are easier to see just visually, just to eyeball on time-based bars. But anyway, so that's what that is. Now, it comes back down. We see momentum coming down right away. So we've got 5-wave downtrend on momentum. And price comes below the 50 MA, but the 50 MA is still angling up. So that is the basic structure of our rubber band trade. Price below an upward angling 50 MA. Now, that's great, but we also have something else, and this supports the rubber band trade here, and that is the 5-wave downtrend on MOM. So it's also a reload pattern, because a reload pattern is when you have 5 waves down on MOM, while the 50 MA is still angling up. So 2 trades in 1. This is what we call a concurrent trade setup. We have 2 different top dog trading setups happening at the same time. So that is great, and it goes right back up to the 50 MA, which is our primary target, regression or reversion to the mean trade. And then it gets a little bit above it. And then, look, it's kind of interesting. Price continues up while the 50 MA angles down. Why is that? Oh, by the way, I forgot to mention this. We also had a nice mini divergence pattern here at the bottom of this. So that always helps, too, with any kind of trade. Okay, so now let's analyze this, because this is one of these quirks that it's nice if you understand what's going on, and then it's not so mysterious. So we've got a 50 MA angling down, but we have price moving up. So what the heck is that all about? Okay, and the reason that happens, nothing wrong is happening. Indicators are just mathematical calculations, mathematical equations. So they're never wrong. They are correct with the math. So you have to understand that how it's being configured is the 50 MA is the 50 bars. So whatever your time interval is here, in this case we have a 1,000-tick chart, so it is measuring the average closing price of the last 50 bars. So it starts angling down here. Why? Because, well, I don't know if I want to count all the bars, but we've had all these bars here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, so something about 30, 35 bars have been going down. And before that, we had a few going up. And so it averages that all out, and it says, well, over the last 50 periods, or the 50 bars, we've been going down. And it continues to go down. Why? Because each time you form a new bar, it takes 1 bar off of the end here. And so pretty soon, it's more dramatically down even, just continues the effect of it going down, or the accretion of it going down. So not unusual. That's what we mean when we say that the 50 MA is a lagging indicator. It's an example of that. But you'll notice that momentum is up. And we get a 3-wave move of momentum there. Then we just get a quick little 1, 2, 3. And the price correlation with that is Just kind of a, little, not much movement there. Just kind of going sideways a little bit. All right, then as we go forward, we put in another one, a long one. Now, that is, again, another signal. In fact, especially with tick bars. Okay, here's another little extra tip for parabolic moves with tick bars. So you won't get as much of an angle as you will on time-based bars, like I said. But one of the giveaways will be that there will be a lot of bars from the cycle low to the cycle high, because it is, you got so many trades coming through that it creates all these bars. Every time a thousand trades come through, a new bar forms. So in parabolic moves, you got a lot of trades coming through very rapidly in a very short period of time, but you don't get to see the short period of time effect as much on a tick chart as you would on a time-based bar. So you see a lot of bars instead. And that's one indication on a tick chart that you've got a very parabolic move. So one of our rules for parabolic moves is we don't take the first retrace after a parabolic move. It just is not a high probability trade. Again, there are logical reasons for that. Primarily the reason, it's not that hard to understand, I guess I can explain it pretty quickly, is that the market already had such an aggressive bullish move in this case that the market participants are looking at that and saying now, well, some are just going to take profits because they're like, dang, I made a lot of money in a short period of time. Cool, I'm going to lock that in. So that money comes out. Then people who might be thinking of getting in, they're thinking, wow, I really missed this. This made a nice move all the way from down here to there. And in what period of time? Like 10 minutes, a little more than 10, 15 minutes or so. And so they're saying, yeah, that was pretty good, but now I'm late to the party. I don't want to be late to the party. The deal might be done. I missed it. And so that's the thinking, and therefore you don't get a lot of more buying coming in, and therefore it's not a high probability trade to take the first retrace. So you wait, and you wait for a complex retrace, and in this case, it just kind of goes sideways. It channels. So another point with the mom waves, 1, 2, 3, 4, 5. Now, look where 5 is. 5 is where? It's at the 0 line. So what that means is that visibly you got a 5-wave downtrend pattern on mom. That does not mean the momentum is bearish. What? Yes, that's correct. It wouldn't necessarily, it could be bearish. You honestly don't know for sure just based on a downtrend on mom. When it's above 0 and it's moving down, but it's still above 0, you don't know whether it is a bearish momentum move or that the bullish momentum is just coming out of the market and there's basically no momentum. So if it goes back down to 0 and then goes up, that means momentum just came out of the market and it was not bearish momentum. If it goes below 0, then that is bearish momentum, strength to the downside. So in other words, this is not strength to the downside. This is just it's kind of like the rubber band trade in a way, in the sense that it's a reversion to the mean dynamic of mathematics. It's just reverting back to 0. That's all it's doing, but it has to travel to get down there. So it's just reverting back to 0. It's really 0. Momentum is already 0 up here. But in order for it to show on the graph, it takes time to graph it. And that's why visibly it doesn't, it's not really identified until there. So again, another little tricky. These told you momentum is a little tricky. Now, is there a way to determine whether that downtrend, while it's still above 0, is bearish momentum or if it's just momentum coming out of the market? And the answer is yes, with price action. So the key is simply we've got this channel here, And because it's just going sideways, that indicates, okay, momentum just came out of the market. It's holding the 15 EMA. That's another way to look at it. It's just going sideways as the as mom goes down. Therefore, it is not bearish momentum. If it was bearish momentum, then price would break down below the 15 EMA, probably go down to the 50 EMA, might pinball here a little bit, whatever it's going to do after that. So that's how you know you got to watch your price action in connection with the indicator, because the indicator just, indicates. That's all it promises to do. Okay, then after that, we get a sweet trade. Then we get a wave 5 here, extended wave count to the downside. And we're still, after all of this stuff, all these bars, we're still just in a wave 2, a first retrace in the trend. And that's great. We like first retraces in the trend. Now, here's what I told, one of the things I alluded to earlier is if you can get a trend trade that also gives you a momentum signal, and that momentum trade signal occurs early in the new trend, that's fantastic. That's considered a fewer better trade. We love it. So one type of trade like that would be the first cycle low after dad turns up. We talked about that one. Well, here's another one. So this one would be the reload pattern. A reload pattern, wave 5, but in a first retrace in the trend. So that is a beautiful thing. We love it. Look for it. It helps increase the probability of the trade succeeding. All right. Now, here we go. This is an example of what I was just talking about. So, okay, we took that. We got up to 3. Cool. Then, guess what? Dang it. Momentum starts coming out of the market again. We put a downtrend on momentum in. Now, this then, therefore, does not allow the market to go up and make it does make a higher high, okay? So it does make a higher high technically and literally, but the real body does not get above wave 3. So therefore, the wave count for price waves is, my drawing tools are going kind of crazy here today. Take that off of there. I don't know what's happening. I think maybe my mouse is skipping in my mouse pad or something. But anyway, let me try to hold this down. See, there it goes again. I might need to get a new mouse or mouse pad. Just did that on its own. Okay, so we got a wave 5 there, failed 5. So, and that's because, again, momentum has already started going down. Going down, down, down. So when momentum goes down, you can still get a higher high on price. Why? Because momentum can lead price. So it's indicating that, yeah, we made a higher high, but on what? Weakness. Remember, strong trend, weak trend? We're in a weak trend now. So even though momentum has shifted to the downside, yeah, you can still get another higher high on price. All right. And that's cool. Now, what happens here, though, is, as you see, exactly what I talked about. Let me clear these off of here. So momentum, specifically, does get below the 0 line now. As it goes down, puts in a wave 7. So therefore, now we have a bearish momentum. It's not a matter of momentum just coming out of the market. No, we actually have bearish momentum. So that's seen in price by us taking out that low. And then we go into the pinball pattern, just like I talked about. That's pretty typical. We'd go down to the 50 MA, I said. That'd be likely. Put down in that cycle, and then we break that cycle low, and we go down to here. That's what a real bearish momentum will do. It will pull the market down. You will get lower lows, in other words. All right, but despite all that, guess what? 50 MA is still going up. So we get kind of sort of a rubber band structure, but it's not a rubber band trade. I guess it's a rubber band structure in that the price bars are below the 50 MA. That's angling up. But when traded as a rubber band trade, because there's not enough room between the bars and the 50 MA. But it is a second retracing the trend, and it is a reload pattern. So again, it's a concurrent setup, and those are the two setups. So we could take it for that reason. And sure enough, it goes up, goes up, goes up, goes up. Are you kidding me? What? So it goes up. Yeah, we get our 5. We get our 7. We get our 9. We get our 11. Now look at what happens here. Mom and Dad both stay. Let me do it there. Mom and Dad both stay above the 0 line the entire time. That's a strong trend. So when you hear me talking about know the difference between a strong trend or a weak trend, this trend stays strong. Now here's where we get our weakening. That's our first indication that this trend now, which was strong, is becoming weak. But as I said, even after that signal, we often will get another higher high. That's exactly what we do. And then it comes back down. Momentum goes below 0. Price goes below the 15 EMA and goes to the 50 EMA. What? How did Barry know that would happen? Well, that's just after watching it a couple thousand times. All right. And then, now we're not into any statistical significance here. Everything is super extended. We've got a failed 13. We've got a wave 7 down here. Everything's really gone higgly-piggly. All right. But here's the deal. You don't have to get every penny out of a move. Oh my gosh, I'm way over time. Okay. I got excited because these are cool things. And a lot of top dog traders need this. So the thing is that, and I'll just close on this because it's such an important point, and I get a lot of comments about this. And when I do my coaching programs, sometimes people ask me about this. They'll say, let's see if we can squish this up. Nope, I guess that's it. Okay, so anyway, let's say they get in somewhere here, and they get out at wave 5. Okay, and they say, but dang it, I'm so upset because then the market went up and put a wave 7, a 9, an 11, and I should have been able to get all of that. And, some situations you can get some of it, but here's the deal. Here's really the bottom. Don't worry about it. It's a matter of mindset. Well, it's a matter of mindset and probabilities. So as I say a million times, we're trading probabilities, not certainties. There's nobody who knows how far the market is going to go before it ends. I've talked to a lot of professional traders. I've read books of professional traders who say, they've gotten pretty good at entries. I feel I'm a master of entries myself. But they say the one thing I never mastered was to know the best place to get out where it would capture the maximum amount of profits on every single trade. And I would agree with that. I have not figured that out either, and I've not found anyone else who has. So what you do is you just play, they say there's the rules and then the exception to the rules. We got to play the rule. So the rule is 5 waves. Here, the rule is 3 waves on Mom, and that's where your probabilities lie. That's what you trade. If you start messing with that, you get into the area of trading low probabilities. Might work for you once or twice, but most of the time over a large sample of data, it's not going to work, and you will either make less money or lose money. And as far as looking at these kind of situations where when it goes beyond that, and then you grieve this because you're like, dang, I missed that, can't think of it that way. Got to retrain your mind. You cannot think of it that way. The way you have to think of it is, I am trading probabilities scenarios, and I did the right thing because, okay, this time it went further. Well, guess what? Next time, it probably won't. And 9 times out of 10, it's not going to. So therefore, since no one knows how far any trend is going to last, I trade the sweet spot. Then I take my money off the table, and I'll take that money and I'll put it into another high probability trade instead of keeping it in a continued low probability trade. That's how you have to think of it. Take that money then and put it into another high probability trade instead of keeping the money in what now has turned into a low probability trade. That's the professional way to think about it. Okay, I've gone way over time, so I got to stop there, but I just had to say that because that is a common problem. All right, hope you enjoyed these videos and this series. I think it was very valuable. If you have any questions, feel free to send me an email, barry@topdogtrading.com, and I'll be happy to answer.